Now let's examine how liquidity affects stock price volatility. How liquidity affects stock price volatility. So we need to consider introduction to liquidity and stock price volatility. That's number one. Introduction to liquidity and stock price volatility. We need to understand what liquidity is all about. Liquidity is the ease with which an asset could be bought or sold without significantly affecting the price. And you equally need to, understand what stock price volatility is all about. Stock price volatility is the degree of variation in the stock price over time, often measured by standard deviation or beta. All right, it has to do with the variation in the stock price over time, and the tools for this measurement is either beta or standard deviation. So I need to understand that liquidity plays a crucial role in determining how much stock price can fluctuate, influencing investors' confidence and market efficiency. Definitely something that is worth considering, because an illiquid stock could generate greater price variation compared to when the stock is highly liquid. Number two, the relationship between liquidity and volatility. The relationship between liquidity and volatility. So we look at high liquidity. High liquidity. In a highly liquid markets, stock prices tend to be more stable, as large buy or sell orders do not affect the price significantly. So in a low liquid environment, in low liquidity, in a less liquid market, stock prices are more susceptible to high fluctuation because smaller trades can lead to more significant price movements. In the case where liquidity is low, just a little trading volume can cause the price to fluctuate, significantly. Number three, how liquidity affects volatility. How liquidity affects volatility. So in this case, we consider price stability and liquid markets. Price stability and liquid markets. So what happens in this instance? So high liquidity allows for more buy and sell orders at various price points, creating a buffer against large price movements. So whenever the market is highly liquid, you discover that you could trade very easily because there's a buffer. It's a buffer against significant price movements. So why does it matter? So stocks with high liquidity tends to have a narrower bid-ask spread, lower slippage and smaller price jumps between trades. All of these would contribute to reduce volatility. So you also consider increased volatility in illiquid markets. Increased volatility in illiquid markets. And so what happens in this instance? So low liquidity means fewer market participants, which leads to wider bid-ask spreads and more dramatic price swings as individual orders have a greater impact. Generally, whenever the stock is illiquid, a single individual order can cause widespread fluctuation, and that would impact the price significantly. So why does it really matter? Illiquid stocks can they are more likely to experience sudden and sharp movements in price, as even small or moderate order size can create imbalance between supply and demand. That's just a little amount of volume coming in can create problem, can create imbalance between the supply and demand for that particular stock. Supposing you have a little, volume in the supply side and you have a larger volume in the demand side, it will create, real, considerable price fluctuation. Number 4 is examples of liquidity impacts on volatility. Examples of liquidity impacts on volatility. So in the case of high liquidity stocks, example blue chip stocks, example of high liquidity stocks like Apple or Amazon, which have high trading volumes and large market caps, tend to exhibit lower volatility during normal market condition. They have large amount of share outstanding, and so no matter the activities level on those stocks, doesn't really fluctuate a lot. It remains relatively stable. So even if a large investor sells a significant number of shares, the order book is deep enough to absorb the trade without large price changes. I want to share a personal experience now. Even today, before I came to record this particular video, I intended selling a particular stock. I wanted to sell about almost like around 300,000 units. I discovered that in the buy side, they have not up to 20,000 units, and I intended selling 300,000 units. So they had about approximately 20,000 units, on the buy side. I decided not to sell because the buy side cannot adequately absorb the quantity I wanted to dispose. So I had to shelve it for another, maybe tomorrow. I had to shelve it for another day. That's a typical example of what we are trying to discuss in this video. So even if I'm a large investor sells a significant share, the order book is enough to. So in that case, the participants on the buy side cannot really absorb the volume I wanted to dispose. And not only that, there's about 900 something thousand, volume kind of that they want to dispose. So if I add to that existing one, that would be around 1 point something million, on the sell side, and the buy side is just approximately 20,000. So liquidity is very, very important when it comes to trade. And I couldn't even sell because of this matter of liquidity. Please don't like this video and subscribe to this channel to do me a ton of good. So low liquidity example is penny stocks. The penny stocks or stocks of smaller companies often experience much high volatility due to lower trading volume and fewer buyers and sellers. So single investors order may push the price significantly higher or lower, creating sudden spikes or drops in the stock price. So generally, this issue is very, very prominent in penny stocks because most of the times they cannot really absorb large volumes. And if you must sell or buy a large volume in large volumes, it's going to significantly affect the price because of the volatility it will certainly create. Number 5, factors that influence liquidity and volatility. Factors that influence liquidity and volatility. You have market condition. During periods of high uncertainty, example, economic crisis, maybe earning seasons, you discover that liquidity can dry up, leading to more volatile price swings. When investors become cautious, they may decide not to buy. So that particular condition will create kind of illiquidity. And then company size is equally very important. Large companies with, wider shareholder base tends to have more liquidity than those that have smaller shareholder base like penny stocks. The news and events can equally impact liquidity. News or market moving events can suddenly affect liquidity, either increasing if the news is positive, it will increase liquidity, and if the news is negative, it might decrease liquidity, and by so doing, it tends to amplify volatility. Number 6, how traders use liquidity to manage volatility. In this case, they take into consideration risk management. So traders, often avoid stocks with low liquidity during high volatility periods to minimize risk and slippage. This particular concept is very important to traders. They can't afford to trade illiquid stocks. It could be difficult. You consider liquidity first. Then there's hedging. Some traders use options or other derivative investment instruments to hedge against volatility when trading, illiquid stocks. Then they equally consider scaling orders. So large institutional traders may split their orders into smaller parts to to reduce the market impact of their trades. If they were to enter a large order, the market impact will be significant. When they reduce into tranches, into smaller units, they can very easily execute their orders, particularly in less liquid stocks. So these are what we need to consider. Actually, these are how liquidity affects, stock price and volatility.